You opened your brokerage account on a Tuesday, you made money on Wednesday, you lost it all by Friday, and somehow on Saturday morning you were already looking up trading strategies on YouTube. That is not a story about failure. That is the beginning of every single person who ever became good at this. This is every level of a day trader, from the person who just downloaded Robinhood because they saw someone on TikTok turn $500 into $50,000, to the person sitting in a dark room with 6 monitors, moving markets that most people do not even know exist. Level 1 is the gambler. You do not know you are a gambler yet. You think you are a trader. You opened your account, you deposited some money, and you bought a stock because someone in a Reddit thread said it was going to the moon. Maybe it did go up. Maybe you made $200 in a single afternoon and felt something you had never felt before. The specific electricity of being right about something financial. That feeling is the most dangerous thing in trading, not the losses, the wins, because that first win did not come from skill. It came from luck dressed up as skill. And your brain, which is wired to find patterns in everything, immediately decided that you had a gift. Psychologist Daniel Kahneman spent decades studying this exact phenomenon. He called it the illusion of skill. The market was going up. You bought something, it went up. You concluded that you were the reason. The gambler's defining feature is not recklessness, it is the sincere belief that intuition is the same thing as edge. Level 2 is the student who lost money, something happened. Maybe the stock you were holding dropped 40% overnight because of an earnings report you did not know was coming. Maybe you held a position through a news event and watched your account go from green to red in 4 minutes. Maybe you just kept making small losses that quietly drained your account over 3 weeks until you looked up one day and realized half of it was gone. This is the moment most people quit. But the ones who stay do something interesting. They get angry in a productive direction. They stop blaming the market and start asking what they do not know. They learn what a candlestick chart is. They learn what volume means. They learn what support and resistance levels are. They discover that there is an entire language to this that they did not speak. The student who lost money is not demoralized. They are motivated by embarrassment. And embarrassment, it turns out, is one of the most powerful educational forces that exists. Level 3 is the system builder. You have been studying for weeks or months. You have watched hundreds of hours of content. You have read about moving averages, about VWAP, about relative strength, about the open range breakout. Now you need to take everything you have learned and turn it into a system, not a feeling, not an instinct. A system, a set of rules that tells you exactly when to enter a trade, exactly where to put your stop loss, exactly when to take profit, and exactly what to do when none of those things work. The system builder is obsessive about backtesting. They take their strategy and run it against historical price data to see if it would have made money over the past year, or 5 years, or 10 years. Researcher Andreas Klenau, in his work on systematic trading, found that the difference between traders who survive long-term and those who blew up their accounts was almost always the presence or absence of a written, rule-based system. The ones with rules survived. The ones trading on feel did not. Level 4 is the paper trader. You have a system. Now you need to test it in real market conditions without risking real money. Paper trading is simulated trading. You place trades using real prices in real time, but with fake money. Most serious traders spend weeks or months here before they ever put real capital back into the market. This phase is psychologically tricky. Paper trading feels easy because there are no real consequences. You can take a loss and shrug. You can hold a losing position longer than you should because nothing real is at stake. The danger is developing paper trading habits that do not translate to live trading. When real money is on the line, your hands shake slightly differently. Your decision-making slows down. You hesitate in ways you never did when the stakes were fake. The paper trader's job is to build the muscle memory of the system while being honest about the psychological gap between simulated and real performance. Level 5 is the live trader with small size. You are back in the market with real money, but you have deliberately kept your position size small. You're not trading to make money yet. You are trading to prove that your system works in live conditions. You might be risking $20 or $50 per trade. The amounts feel almost embarrassingly small, but this is exactly the point. At small size, the emotional pressure is low enough that you can execute your system cleanly. You can take the stop loss when your rules say to take it. You can exit the winner when your rules say to exit. You're building the behavioral infrastructure that larger position sizes will later run on. The biggest mistake at this level is getting impatient. You have a winning week and you double your size. Then you have a losing trade and the larger loss hits differently and you override your system. Research from behavioral finance expert Terence O'Dean at UC Berkeley showed that overconfidence is the single most common reason retail traders underperform, not bad strategies. Overconfidence in executing good ones. Level 6 is the consistent performer. Something has shifted. You're no longer surprised when you make money. You expected to make money because your system has an edge and you know what your edge is and you execute it consistently. You have months of trading data now. You know your win rate. You know your average winner versus your average loser. You know your maximum drawdown. You treat your trading account like a business and you track every single metric. You have bad days and bad weeks, but you no longer catastrophize them because you understand that drawdowns are a mathematical feature of any trading system, not evidence that you have lost your edge. The consistent performer has achieved something that most people who try trading never achieve. They have separated their identity from their results. A losing trade is not a personal failure, it is a data point. Level 7 is the position sizer. At this level, you have realized that your system is not your biggest constraint. Your position sizing is how much you risk per trade determines your long-term growth curve more than almost anything else. You have discovered the Kelly criterion, a mathematical formula developed by John Kelly at Bell Labs that tells you the optimal percentage of your capital to risk on each trade given your win rate and your average risk-reward ratio. You do not blindly follow it. Most professional traders use a fraction of the Kelly number to reduce variance, but you understand the math. You understand that risking too little means your account grows too slowly. Risking too much means one bad streak wipes you out. The position sizer has found the narrow corridor between those two failure modes. Level 8 is the specialized trader. You have stopped trying to trade everything. You have found your market, your time frame, and your setup. Maybe you trade the opening 30 minutes of the US equity market every day and nothing else. Maybe you trade crude oil futures during the London session. Maybe you specialize in earnings plays on mid-cap tech stocks. Specialization is not a limitation, or it is a superpower. When you trade the same instrument in the same conditions repeatedly, you develop a pattern recognition that goes beyond what any indicator can measure. You start to feel when a setup is high quality versus when it merely looks like a setup. You develop what traders call tape reading, the ability to read the flow of orders in real time and understand what larger participants are doing. This is not mysticism, it is the result of tens of thousands of hours of watching the same market. Level 9 is the funded trader or the prop desk. You have proven yourself. Either you have built your personal account to a size that generates meaningful income, or you have passed the evaluation of a proprietary trading firm, a company that gives skilled traders access to large amounts of capital in exchange for a share of profits. Prop firms like FTMO or TopStep evaluate traders on their ability to hit profit targets while staying within drawdown limits. Passing an evaluation at this level means you have demonstrated not just profitability but risk management and consistency under pressure. The funded trader is no longer constrained by the size of their personal savings. They are trading with institutional capital, which means their edge finally has the room to compound at a rate that changes their financial life. Level 10 is the architect of systems. This is the rarest level. This person is no longer just a trader. They are a builder. They have taken everything they learned about markets, about human psychology, about order flow, about statistical edge, and they have built something that operates without them. Maybe it is an algorithmic trading system that executes their strategy automatically across multiple markets simultaneously. Maybe it is a fund that manages outside capital. Maybe it is a prop firm they started themselves, now evaluating and funding the next generation of level 1 gamblers who just opened their first brokerage account on a Tuesday. The architect of systems understood something early that most traders never figure out. The goal was never to be good at trading.